Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Eamon Nolan, partner with Project Development in Finance at Vinson Elkins, to discuss how private capital is shaping the energy evolution. Eamon, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me, Jill.
Why has there been a substantial shift in private equity deal making to less carbon intensive or lower carbon sources of energy?
As with everything, I think it's more than one individual answer. I think there's just been a confluence of factors that are driving private equity in this direction. I think first and foremost is the LP, the investor demand that is pushing them that way. So you see a lot of managers these days under immense pressure from their investors, who are in turn under immense pressure from their own constituents. Think of pension funds and the like, who are seeing their own members putting pressure on them to push money into strategies that are more than just returns focused. They are actually focused on climate related issues, and I think there is a big push amongst investors to see their money invested in places that is having an impact. But obviously that's more than there is more to it than just that. I think if you look at regulatory pressures, both from a constraining conventional energy in some ways and disincentivizing people from investing in that way, as well as huge investments and subsidies and other government pushes, like today's announcements by the state of New York to put $500 billion into the offshore wind industry. You are seeing a lot of money coming from governments to incentivize investment into decarb strategies, and so I think that's a big factor. Technology is another one. Obviously, the technology is changing and shifting all the time. We are seeing advances in more than just onshore wind and solar. You're seeing enormous turbines being developed for the offshore wind industry. The hydrogen industry is developing at pace. The clean, meaning green or blue hydrogen industry, battery storage technology is changing every day. CCUS the same. So you're seeing technology changes that are making the investments more reliable and more certain, which I think is a big factor for PE investors in particular. And then, all of that, I think you're seeing dislocation in the markets that, as a result of shifts from conventional energy strategies to clean energy strategies, that just creates opportunities for managers. There's nothing that PE managers like more than a bit of market dislocation. And then I think the final one is the public markets are very receptive to exits by PE managers. So think of a de-SPAC or an IPO of clean energy providers. They are have been very successful over the last 12 months, but they will continue to be a big part of the market.
Well, Eamon, let's talk about the individual energies a little bit more specifically. What's the outlook for hydrogen, and why is it such a sought after energy source?
I think the outlook is great. I think you have to break hydrogen up into its components. You've got green, blue, grey as the sort of three big categories. I think really how we like to think of it as sort of decarbonized hydrogen or carbon intensive hydrogen. And I think the shift is away from grey. I think a lot of the investment strategies that you're seeing now are into decarbonized hydrogen strategies. So green being reliant on renewable energy sources to power the technology that actually creates the hydrogen. Blue being more of a capture strategy. So you continue to emit carbon as part of the hydrogen making process, but you capture and use the carbon for in traditional CCUS ways. So I think it's good. I think the investment markets are continuing to see people put money to work into that technology. I think it's not there yet, frankly, from an economical perspective. If you were to invest in a green only strategy, you need very specific circumstances to make that profitable. And frankly, I think government subsidies are a big part of it. Obviously, every government is looking at this from a different perspective. Places like Chile and the UK, Germany are making very big pushes into hydrogen, and I think they'll probably continue to lead in terms of development because you can make returns there in a way that perhaps is not quite there in the US. But there is a lot of movement. We're working on a number of different green hydrogen strategies at the moment, and I think the outlook is very positive. I think it's just not quite there relative to, say, an onshore wind or a solar.
And that was my next question to you. How does it compare in the investment cycle compared to solar and wind, which sounds like it's a little bit more mature and there might be some more options there?
Yeah, I think the technology is probably relatively far advanced. I think it's really a cost curve issue and just bringing the cost down in terms of putting the tech together and building a green hydrogen plant is just currently not really at a place that, onshore wind, solar, etc. That those technologies are very established. Even battery storage technology is really now considered more of a mature technology than a sort of developing technology, notwithstanding that technology is changing and improving every day. So I think there is a kind of a good analogy to those markets in that you can sort of see it plotting similar paths to hydrogen, to the wind and solar markets, but from a cost perspective, that's really where I think it's lagging behind at this point.
And Eamon, you had mentioned before that New York is going to complement its third offshore wind leasing round by investing up to $500 million in offshore wind port manufacturing, supply chain projects. In reality, how long would it take to get a project like that online?
I think it depends on the project. If you look at traditional ports investment, I mean, there is no magic to an offshore wind port development that is different from any other port development in a lot of ways. You obviously need very specific kind of docking abilities, staging areas for, you've kind of got two different phases, right? You've got the construction of the offshore wind where you need a certain type of vessel that can be used and taken out. And then you've kind of got the service period where you need O&M vessels to kind of do that work. But from a port development perspective, that's not very difficult to put together. And so I don't think that people are thinking about those sorts of investments as being particularly challenging. I think the big challenge with offshore wind remains transmission. How do you bring in this enormous amount of power from the ocean into the right entry points, keeping in mind that our grid is not set up to take delivery of enormous amounts of electricity from the ocean at the moment. There are certain sites that are there and ready, and the very early stage movers in the offshore wind industry have taken advantage of those sites. Think about decommissioned power plants, nuclear power plants, etc., that are coastal. Those make for obvious sites to bring in the electricity. But I think the big investment that's going to be needed, and frankly, that this is true in the onshore space as well, that one of the big investments is transmission, and how do you bring it all to load.
So what are your thoughts on consolidation in the traditional energy sector? I mean, we're still going to need to utilize some of those forms of energy until a more green ecosystem is logistically available.
Yeah, no, absolutely. I don't think there's any realistic scenario in which you can just turn it all off, and that's not going to happen anytime soon. I think there'll continue to be consolidation. I think there are obviously opportunities in the conventional energy sector, and just in the same way that there is some dislocation in the sort of decarb markets. Obviously, this shift away from conventional energy is creating opportunities for opportunistic managers to go in and take advantage of that dislocation and pick up bargains and find opportunities. And so I think that there will be consolidation. PE managers and conventional strategics will go out and continue to find the right opportunities. I think, until we've seen any number of issues where grids just cannot rely on clean electricity alone at the moment. And the technology just is not there, and the grid and the infrastructure is all just not there. And so there's going to need to continue to be for years to come a combination of power supply that involves conventional energy.
All right, Eamon, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.